Hey, welcome back to my channel. My name is Maher Abiad, and I provide you with the leading financial education content on personal finance, investing, and getting out of debt so you can finally live a life financially dominant. And you're going to get so much value out of today's video as I'm going to give you the knowledge you need to start investing in the stock market the right way. I remember the first time that I got into trading was back in the late 90s during the tech boom. I remember trading stocks such as Qualcomm, Cisco, and Juniper Networks. I learned a ton about investing and the markets in that time since then. And in this video, I'm gonna be sharing with you everything you need to know about stocks, brokerages, and analysis, and the terminology you need to know so you can get started on the right foot starting today. And of course, why I'm so passionate about stocks and investing, and why I think it's so important to invest in stocks in order to really grow your money and get rich. Make sure to stay until the very end of this video as I'm gonna be going over how to analyze stocks the right way to find the best ones to start investing with using both fundamental and technical analysis. So to get started, before we can start to buy, sell, and trade stocks, we need to know what are stocks in the first place. There exist private and public companies that have directors and shareholders, and for the sake of this video, I'll be talking about stocks in the light of a public company. A stock is a security which is also called an equity, and it represents a piece of ownership of shares in a specific public corporation. Now, these shares signify proportionate ownership of the shares in the corporation which has issued them. For example, if a company has 100,000 outstanding shares and you buy 1,000 shares, you will have a 1% ownership interest in the company's shares. When you buy a stock, you are not actually owning a piece of the corporation. Rather, you own a specific number of shares that are issued by that corporation. When you own shares, you have the ability to receive dividends if issued by that company. You can also vote at the shareholder meetings, and you can sell those shares to someone else at a later time. Stocks in the United States are bought and sold on exchanges, such as the New York Stock Exchange, also known as the NYSE, and the NASDAQ exchange. In Canada, the big exchange is the Toronto Stock Exchange, also known as the TSX. So now let's take a look at an example of a company that most of us already know and recognize, Apple. Apple has a stock symbol of AAPL and trades on the NASDAQ exchange. A stock symbol is also known as a ticker symbol. It contains a series of letters that identifies the stock on exchanges. On the NASDAQ exchange, tickers can be up to 5 letters long. On the New York Stock Exchange, also known as the NYSE, ticker symbols can be up to 4 characters long. Apple, as of the recording of this video, has a current stock price of $129.87 at the close of the last trading day. We can also see a couple more very important numbers that you need to know, and that is the bid and ask price. So the bid price is the highest price someone is willing to pay for that current equity. So in this example case with Apple, we can see that is $129.64, and there are 1,200 shares requested to buy at that price. The ask price is the lowest amount someone is willing to sell or let go of their shares to the market. As we can see here, that is $129.74, and there are 800 shares offered at that price. The difference between the bid and the ask price is called what is known as the spread. Companies like Apple, which are more heavily traded and not as volatile in price, have tighter spreads, so the bid and the ask are fairly close together. You will see bigger spreads with stocks that perhaps have lower volumes, are not as actively traded, or are much more volatile in their price movements. Stocks are definitely one of my favorite types of investments and an asset class I am very familiar with. What is so fantastic about investing in stocks is that over the longer term, the broader stock market has a positive and upward bias. In a job, you put in 8 hours of time and actual physical work to make $200 in a day. With stocks, you can make $200 in minutes just because it doesn't require your time nor your energy. That's the thing about wealth. In order to get wealthy, you have to have sources of income and put your money into things that can do the work for you and grow without you having to put in your own time or energy, or you physically having to be there, because a job is not scalable. Stocks are scalable as you can continue to dollar cost average in over time and see your assets grow. If you have a friend or family member that is also interested in learning about stocks, how to trade, and the stock market, and you think would benefit from the content in this video, make sure to share the YouTube video link with them now so they can also get the value you are getting. So in order to buy and sell stocks, you need a brokerage firm account to put your money into, to then buy and sell the stocks and equities you want to participate in. For me personally, the go-to broker that I have been solely using for my stock trading here in Canada is Questrade. They provide some of the best tools that you can use no matter if you are a short-term or longer-term trader. I will also link to them below if you want to learn more and sign up if you are a Canadian resident. So when you place an order, you place your order to buy or sell within your brokerage account. Then the broker acts as an intermediary between you, the client, and the exchange. They place the order with the securities exchanges, and those shares are then transferred to or from your account. So the brokerage handles all the money processing and the exchange of shares in and out of your account. This is called your positions. Most buy and sell orders are settled 2 business days after the day the order executes. When you log into your brokerage account, you will have a screen in your main dashboard that shows you your balances. You may have balances in Canadian or US dollars currency, depending on your country. Then you will have an order screen or tab which shows you your current open orders. Those are orders that have been accepted by the exchange but not yet filled. And then you will see executed, orders that have been filled either fully or partially. So when can you trade? The stock exchanges are not open for trading 24 hours a day, 7 days a week. There are specific times that you as a retail investor can place orders to have them filled. You have regular trading hours and then you have extended trading hours. Most of the activity on a stock happens during regular trading hours, and that's when there is the most liquidity. You'll find more people offering to sell their shares and willing to buy them to take them off your hands during these times. In the United States, stock exchanges are open from 9:30 a.m. to 4 p.m. Eastern Time. During extended trading, you can still trade depending on your broker, but are limited to how. For example, the route of the trade may only go through the NYSE ARC exchange. The problem with trading during extended hours is that there is less trading volume and there may be more intense price swings, especially during an earnings call, for example, which usually happens after the closing bell, where companies report their quarterly earnings. The pre-market is between 4 a.m. and 9:30 a.m. Eastern Time, and after hours trading is from 4 p.m. to 8 p.m. Eastern Time. Again, extended market hours are not open to all retail investors, so check with your specific broker. In this video, I will go over 4 common order types that you will most likely use the majority of the time in your stock trading. The first one is a market order. This is a very simple order type where you are able to buy or sell a security at the best current market value at the time your order is sent to the exchange for execution. This is where you say, I want to get in or out as quick as possible, and I will take the best price available at this time. A limit order is one where you can be much more precise in your trades, where you say, this is the maximum price I am willing to pay for security when buying, or the minimum price I will accept for selling a security. A stop loss order is one that is most commonly used when you already own a stock and you place a stop loss at a certain price below the current price in order to limit the losses you may experience if the stock price goes down. When you place a trailing stop order, what happens is that this order will trigger a market order to sell or buy a stock once the price reaches a specific percentage or dollar amount that is below the peak price point for a sell or above the lowest price point for a buy. In this video, I'll be going over 4 common order durations that you can use in your trading. For the day order type, the order stays active until the end of the current trading day. If by the end of the trading day, the order is not filled, it will get canceled. For a good till date order duration, this order will stay active until a specified date in the future. Again, if the order is not filled by that specific date, the order will get canceled. With a good till canceled order type, this order remains active until the order gets filled or you manually cancel the order. One thing to note here is that the maximum length of time the order type can remain active for is 90 days. Otherwise, it will then cancel automatically if not yet filled. When you have a good till extended market duration, this order will remain open for the current trading day, which also includes the pre-market and the post-market hours until the order gets filled. And before I go on, if you've gotten even one piece of value from the video so far, make sure to hit that like button, as it really helps to support the channel. So now that you know how to buy and sell stocks, let's dive into one of the most important topics related to stocks and trading, and that is, how do we go about analyzing stocks to see which ones are actually good buys in the first place? With that, we have a couple routes to take. The first is called fundamental analysis, and this is where you dive deep into the books and human side of the company to look at things like profit, PE ratios, looking at their income statement, the company's directors and board, and so on. With fundamental analysis, you're really looking into the financials of the company to get a picture of its financial health and profitability. So some important things to look for is the market cap or market capitalization. This refers to a company's total dollar market value based on the outstanding shares of stock. To get this number, you multiply the total number of outstanding shares a company has with the current stock price of one individual share. Another metric to look for is the price to earnings ratio, or what is also called the PE ratio. This is used to help with valuing a company, and it measures the current share price relative to its earnings per share, or EPS. So next, what is EPS? Well, that stands for earnings per share, and it's derived through the company's profit earned divided by the outstanding shares of its common stock. A higher EPS usually means a company is more profitable. Other important things to look at when you are doing fundamental analysis is to look at their income statement, balance sheet, and cash flow. Looking at the industry the company is in, the company's competitors, and how is the company positioned in the marketplace. And finally, you can also look at upgrades and downgrades. This is where analysts will put out recommendations of stock upgrades where they feel more bullish or positive of the company's future, or they may issue a downgrade where they feel negative of the company's outlook. On the flip side, you have my favorite stock analysis technique, which is called technical analysis. With technical analysis, you are more focused on the stock charts, price action, and movements of the stock, and what it has done in the past. You use charts to help you get a better view of what the stock might do in the future by using its price action to see what breadcrumbs it's left to help give you an indication of what the stock might do next. I've always been a technical trader. I absolutely love looking at stock charts to see where fear and greed exist in the price of a stock. So one of the biggest things to look for when doing technical analysis is trying to identify support and resistance levels. With support levels, this is where there seemingly exists a floor where the price can't seem to break through on the way down, where it may temporarily take a pause. So during a downtrend, there's a concentration of demand and buying interest at that level. On the flip side, with resistance levels, when a stock is rising or is in an uptrend, there may exist a level that acts as a ceiling where a stock has difficulty breaking through on the upside, where a concentration of supply and selling pressure exists. Another important thing to look at with technical analysis is trend lines. These are diagonal lines that create recognizable lines that a stock trader can use to see the prevailing direction a stock is going in, either up or down. This is where you draw a line that touches the pivot points of the stock price underneath of an uptrend or above a downtrend. You may also look at things such as the day's range to see if a stock is trading near the high or the low of the day, as well as the volume for the day, so you can see any irregularities. If the stock has a surge in trading volume, there may be news out which you should check for which is affecting the stock. And finally, it's important to look at the stock's open and close prices. A stock can also trade during aftermarket hours and pre-market hours. So this can help give you an indication of what the stock may be doing. When it comes to stocks, there are a few important dates that you need to keep in mind, especially if you own stocks that pay out a dividend. The first date I will talk about is the ever so important earnings date. This is where a company releases their financial report for the previous quarter, and they talk about their profitability or losses for the period, along with any outlooks, guidance, or changes for the upcoming quarter or year. When it comes to dividends, the ex-dividend date is important because this is the date that is set, which is usually one business day before the record date. This date is not set by the company, but by the exchange. So what happens is, if you decide to go buy a stock on or after its ex-dividend date, you will not receive a dividend. However, if you own the shares before the ex-dividend date, you will get the dividends. Now, the record date or date of record is the date on which a shareholder must be on the company's books in order for them to be able to receive the dividend. The record date is set out by the company itself. Now for the exciting payment date. This is the date that the dividend is actually paid out to all of the shareholders. So for example, the ex-dividend date for Walmart was on March 19, 2020. The records date was on March 20, 2020. And the payable date was April 6, 2020. Thanks so much for sticking with me until the end. If you learned something new today, make sure to smash that like button so others can also find out about this video. And if you don't want to miss out on weekly investing, money, debt repayment, and wealth videos just like this one, subscribe right now so you can become financially dominant and financially free. Leave me a comment down below right now and tell me what is one new thing you learned in today's video about stocks that you never knew before. That way I can make even more videos just like this to help you out in the future. If you want to learn more about money and investing so you can get wealthy, then you will definitely want to watch the next video in this playlist, which you can click on in the upcoming end screen, and I'll catch you in the next video.